Thanks for joining us today. This is your host, Kenyatta Goins, along with Roberta Goins and Torrey Jones. And I'm sure we're all so excited that you're here. And our goal is to teach, coach, and train you and make you the best that you could be. Perhaps you're new to real estate or sales, or you could be a seasoned veteran. I'm sure there's something that we all might have here for you to help teach, coach, and train you on and give you the best direction of mentorship that we can do. We've partnered with some of the top producers in the industry, as well as other business professionals and entrepreneurs, and we bring them on our calls weekly and monthly. So you never know what you're going to get, but you're going to get a lot. So always keep your pad and paper with you and enjoy the program. God bless. I'll talk to you after this program is over.
So I'm going to go ahead and get started just in the interest of time. Good evening, everybody. My name's Torrey Jones. For those of you that I haven't met, but I believe I've met virtually everybody here. Hopefully someday we'll be able to meet soon in person. But thank you for joining us again tonight. We have another good call with a bunch of good information lined up for tonight. Tonight we're going to be talking specifically about the lending side of the residential real estate business, specifically just because we've been working with a lot of great lenders here in Phoenix, Arizona, and they actually have offices throughout the U.S. But they'll be coming on the calls coming up, talking about different things. So we figured we'd get the team a little bit of a refresher on just what are the different types of lending, what do you specifically look for in lenders, what's the benefit of different types of financing, and then how you can best prep your client in order to get ready for selecting whatever type of financing they'd like. So again, TGRI's mission, what we're here for today is to help 100 families and 100 agents. This is what TGRI is about. This is our mission, is to really educate our agents so that they can be more servants to their clients and be that fiduciary agent in order to help them change addresses, purchase another home, whatever they're specifically looking for. We're just hoping to help as many agents and families as we can. And the best way that we do this is through centralizing the best practices and tools into one location, building up our agents because we're an agent-focused team. The way we do that is we have calls like this where we try to pack as much information out there, and we listen to the feedback from our different team members on what we can talk about, so then we can help address different problems that agents might be facing in the field today. And then lastly, our main focus is to help agents really become a business and figure out how to best position themselves and focus their time and effort and talents in the right direction so that they can go start a business and start to be successful in real estate. So each of these different pillars has different types of tools and things that we use. So within centralization, we have a ton of SOPs and things. We're actually in the process of coming out with physical books that we'll be able to give to different members of our team. So we're in the process of just kind of finalizing all of that information, but that should be coming soon. So we'll have more information later on about that. Again, virtual trainings like this. And then we also like to just talk about the latest trends and different things that are happening out in the greater real estate market. Agent development, we have a lot of mentorship and training that we're developing. We just started this team this early February this year. So a lot of these things are just being completed, being built, and they're getting ready to be rolled out. But we got agent playbooks, different types of cross training. So if you want to become a TC, if you want to make a little bit extra cash, I know our team's getting a lot of good transactions coming in, so we're in need of TC. So that's just something that we're going to eventually be offering, so you can go and get trained up on that. And then business development, we got business coaching here. I know Kenyatta has a lot of our mentors on EXP, so we can always reach out to him and set up one-on-one time to get mentored and help build your business more specifically. So as always, we like to start each call with a little bit of activity and learning moments. So these are just an open forum for everyone who's on the call who would like to kind of talk about any type of recent real estate or any other type of life activity that's going on in your lives today, and what you might have learned from that, anything that you're looking forward to or happening. So I guess I'm going to open up the floor. How's that listing going, Kimber? How's everything moving along with that? Inspection period, right?
Yeah, so the buyer waived inspection, so that was pretty easy.
Oh, that makes it easy.
So I've got the inspection report and the termite report. They came back pretty good. So even if we were in that window, I think we would have breezed through that as well, based off of what I was able to see on both of them. So right now we're just focused on the appraisal. So awesome. That's the next step. So yeah, we're moving pretty fast. I think the close of escrow is supposed to be 10-5. I think we're going to beat that.
Yeah, that's awesome. Yeah, it's just waiting on that appraisal. I'm having a similar situation in which, for those of you who, I'm sure everyone here on the call knows, but appraisals are done actually by an independent third party. So we're always at the beck and call of this third party and their schedule, really. Which can be a frustration at times, because in my recent transaction, we breezed through the whole Binzer period, had all of our paperwork and everything in, but then again, we're waiting for the appraisal. So if you're in a similar situation, what I've been doing is I've just been hounding the lender just to let me know when it's going to be coming in. I've been trying to be like, hey, give me the name of the company, let me contact them so that they have my information so they can contact me as soon as possible. Just different things to try to facilitate the transaction, but sometimes you kind of have to wait. But yeah. That's good. And then I know Kenyatta just got a listing. It's coming soon, so that's going to be coming up pretty soon. I think he said he's already got multiple offers on it. So that's one of the great benefits of kind of marketing your coming soon listings, especially in a market like this. You really just want to start marketing as soon as you can, of course, following those different rules and guidelines when it comes to marketing coming soon.
I'm in today.
Oh, you had another one today?
Low baller, but Roberta could talk about it.
Okay. Is she on the call? I don't have everyone on here.
Yes, she's on.
Lately, but I'm driving, so I really can't talk. I'm sorry, guys. Driving.
Yeah, no worries, Roberta. It's all good. Joyce, were you trying to say something before we?
Yeah, lately I've been seeing posted on the what do you call them? Telephone poles and where realtors are offering to sell your house for 1% and 2%. How do you combat that? Yes.
I've only seen it that low in San Francisco. LA is not even going that low.
Yeah, they put it on telephone posts. And it's not really, it doesn't have like Coldwell Banker or anything like that, but it says, we'll buy or sell your house for 2% commission.
Now, question. I was just out doing showings this Saturday, and the showing that I went to was 72 sold, and they were trying to recruit me.
Dawn and I could say the same thing.
Yeah. The question I had that they did not answer directly, when you see that 2%, they're talking about their portion. Keep that in mind too, because when you write up the contract, that's like you saying I'm only going to take 1%. So when they're advertising that, it's really what they're going to, they're saying that this is what they're going to do. Now the buyer agent still has to get paid. So it's really not 2%. So be mindful of that. But I was catching the guy when I was talking to him in regards to that, because that was a factor. I said, so if you could do it for 2%, so you're walking away with 1%. And that's not the case at all. Really, you're still around the 4.5%, 5% when you're writing up the contract. So keep that in mind. Okay, Joyce?
Well, the other thing is that a lot of states are now moving to where the buyer is paying
Yeah.
the agent directly versus the seller paying. So when they show that 1%, they're selling your house for that. The buyer then has to pay full board commission to the buying agent to get that house.
Right.
Mhm.
So that is something that we're starting to see a new trend in. Thank God it hasn't hit here yet, because that's a whole nother ball game. I'm gonna have to return to class for to get you guys up to speed on.
Yeah.
Yep, because that's difficult because, and that's something that Kimber was kind of alluding to, is that the commission is a two-way split. When you're making the agreement with the seller to list their property for a certain commission, you got to be upfront that this is split between two agents. And as a buyer agent, especially as the market starts to slow down and more listings come up, they're not necessarily going to be incentivized to really hustle and sell your house, and get their buyer to purchase their house if they know that their commission is going to be, 1.5%, 2%.
Right.
So you always got to think about the other side when it comes to these types of things, and also just express the value that you bring, in the sense that your time and your effort and what you're going to do and the value you're going to produce for that seller is worth more than that 2%. And that is differentiated from the kind of low ball, low commission.
Good point, Joyce. Good bringing that up.
Yeah, thank you for that. That's a good one.
Yeah.
So moving on to tonight, we're really going to just talk about residential financing. So what is residential financing? What are the different financing vehicles that buyers typically use? We're not going to cover all of them. These are just going to be some of the typical ones that you're probably going to find in the market today. And then we're going to talk about who is really selling these types of loans. And then lastly, we're going to talk about how do you kind of prep your client to go, if they haven't already met with a lender, how you can kind of help align with them and really bring them down to earth in terms of expectations, moving into getting not only pre-qualified, but then also moving through the whole transaction. Because a lot of these things, when it comes to closing costs, you don't just pay that all at the end. You pay a lot of these closing costs during the transaction. So it's really good to educate your client moving into a transaction on all the fees they're probably going to be having to pay. So first, we're going to just talk about the residential financing types. So when I say residential financing types, there's really 5 main financing types, and they're kind of broken down into conventional or commercial and government-backed loans. So when it comes to conventional financing, those are commercial loan mortgages, and they're usually private banks or companies. So these types of loans are not insured by the government, which means that when these types of institutions are making loans, they're technically in their perspective, they're taking more of a risk financing you. So therefore, some of their qualifications and such are going to be a little bit more stringent. You're typically going to see with conventional type of financing or other types of financing that doesn't require government backing, that it's going to be a little bit higher credit scores may be required. They might need a lower debt to income ratio, just some of these specific things when it comes to conventional financing. When it comes to government backed financing, there's really 3 major types of loans. So you got your FHA, or the Federal Housing Administration loans. So these are a mortgage that is insured by the government, and they're designed to be very low to moderate income borrowers. So this is in an effort to help more people be able to qualify for these types of loans. So the government came up with this kind of program in order to lower the minimum insurance or the minimum credit score that you need, as well as increase the debt to income that you would need compared to a conventional loan. Another one that I've used is the VA loan. So this is for specifically veterans and their spouses, people who served more than, I think it's 190 days of active duty service qualify for this loan. It's got a lot of really good benefits, such as 0% down, but then it also comes with a lot of specifics. Same thing with the FHA loan. So with government-backed loans, they come with kind of like a caveat. So they're easier to get into, but there's typically more restrictions and then more background checks and more due diligence done on the part of the bank in order to qualify for these government-backed loans. So that's something that's true across the FHA, the VA, and the USDA. Appraisals are typically going to be a little bit more stringent. They might come in a little bit lower. The government's going to demand that they have mortgage insurance in order to protect their asset or their investment in this property. There's a lot of other just specifics. You have to live in the property when it's a government-backed loan. So you can't just buy a government-backed loan as an investment property. You actually have to live in it. So there's just some certain considerations to kind of educate yourself and the client when it comes to these different types of loans. But the VA is the second type of government-backed loan. And lastly is the USDA loan. This one's from the Department of Agriculture, and this is more in like rural areas, but it has a lot of similar benefits with 0% down. But again, there's a lot of specific qualification requirements that we're not necessarily going to get into tonight because we got a limited time, but it's just something to kind of generally look at. So each of these different types of loans are going to have different types of lender fees. And here on the screen, I got some of the general types of lender fees that you'll typically see when it comes to the most loans. But of course, this is all going to depend on who you're purchasing the loan from, because, for example, some of our partners who are mortgage brokers, they actually don't charge any lender fees, which is a really, really big benefit when it comes to clients being able to qualify and they're looking at their closing costs. But if you're not working with a lender like that, some things your clients might need to look out for when it comes to their closing statements are origination fees, mortgage broker fees, discount fees, processing fees, underwriting, application fees. I see I doubled up on some of these, so apologies. I'll make the edits later, but these are just all different ways that the lender is getting paid. Because they're spending time and resources in order to help process your loan, and they have staff and such, and this is kind of how they collect that information on the back end. So on the bottom, something really key that you need to pay attention to is that typically closing costs for residential purchases can range from 2% to 6% of the loan amount. So 2 to 6%. So you really need to educate your clients up front, and we'll talk about this at the end of the presentation, but really just letting them know as you go into the transaction that, hey, this is the frequency and these are the types of fees that are going to be charged. And what I'm showing here on the screen are just lender fees. Other types of closing costs are also your home inspection, your appraisal, any type of title fees, taxes. Another type of fee is also mortgage insurance. Specifically, if you're getting any type of government-backed loan, they typically require that you pay 12 months of home insurance prior to closing. So this is something that you really got to pay attention to. And when you're talking with your clients about these different types of fees, it's good to kind of understand the details because, for example, with home insurance, a home insurance, that 12 months of home insurance that may be required by that lender, that could actually be wrapped into the loan itself. So for example, I'm helping out a gentleman in Sun City, and he doesn't really have a lot of cash on hand. He's kind of preparing for his Medicaid years when he's going to have a fixed income. So he's really looking for something that's not really he doesn't really have a lot of cash to pay, especially as we're getting closer to closing. And I just informed him the other day that, you know what, this $1,200 that you're going to need for your home insurance fee, how about we just wrap this into the mortgage, because your mortgage is only $150,000 right now. So that extra $1,200 to your mortgage, you're tacking that onto your 30-year fixed rate mortgage. And with mortgage interest rates being so low today, that's not barely going to move your monthly payment. So you're stretching that payment out. You have a little bit more cash to go help with moving expenses and different things. So this is something you really want to let your buyers know, depending on their situation, that, hey, this is an option for you. Are there any questions on this before I move to the next slide? Okay. So here I just got a little breakout table with some of the major comparisons when it comes to these different types of loans. I didn't put USDA in here just because, one, I don't have enough space, and two, you just don't see it very common here in the Phoenix market. I don't know about Detroit or in the Tennessee. I don't know if you deal with a lot of USDA loans out there, but if you do, please pipe up and we can always go into detail into that. But the first line is property residence. So as you can see here, conventional loans, other than cash, which I didn't go into, but everybody kind of knows cash is kind of king, especially in this market. You might be able to get a property for a little bit cheaper. There's less qualifications because it's your money. And of course, that's the quickest and most liquid way to purchase real estate. But besides cash, conventional loans is the only type of financing between these types of financing that you can purchase a second property that could be an investment property. So you don't have to live in a conventional loan. But if you have a FHA or VA, it has to be your primary residence. A lot of the benefits that come with this come with the price of, hey, you have to live in it. You can't really house hack it and, use it as an investment. You got to get really creative if you want to try to do something like that. Next, we got minimum down payment. Conventional, you can go down as low as 3%. FHA, online, it says that you can go as low as 3.5%. That's really going to depend on the lender and the buyer's specific risk profile, so their debt to income ratio and a lot of these other things. So I've seen a lot.
They're getting also if they're getting loan assistance in the program.
Yep, absolutely.
To raise that rate up a little bit.
Yes, absolutely. So it's all of these are just general numbers that you can kind of float around, and they're not necessarily hard stick to numbers, but in general, these are kind of what we're seeing right now. Financing fees. So this is something that's pretty interesting in regards to these different loans where most have typical lender fees, but with a VA loan, if your VA veteran doesn't have a disability rating, as in they weren't injured in some way during their service, then they're most likely going to have to pay a 1.4 to 3.6% VA funding fee. So this is different than a down payment. So VA, you could still get a 0% down payment, but you may have to pay that funding fee if you don't have this if you weren't disabled in active duty. So this funding fee is used to help refund the government basically trust that helps all the veterans get this 0% down. So when you pay this 1.4%, that money goes back into that big puddle of money that they use to help other veterans. So that's kind of what the 1.4 that VA funding fee is for. Mortgage insurance, conventional loans, if you have less than 20% PMI, which means principal mortgage interest, is something that you'll be charged. So this is an additional interest that's added onto your loan, just because technically the mortgage company, the conventional loan, they have more risk lending to you because you don't have as much equity in the property. Therefore, they're going to request more money. So when you think about banks and interest and all this, it's all based off of risk. So by increasing your credit score and increasing your down payment and increasing your debt, decreasing your debt to income ratio, in the eyes of a lender, you're decreasing their overall risk. Therefore, they might give you a lower interest rate. Therefore, they might give you more money to purchase a house. So if you think of it in that terms, that's really all it is you're trying to make your profile as you yourself look less risky as a loan to a bank. But either way, if you have more than 20% down payment for a conventional loan, you do not have to pay PMI. The major mortgage insurance fee and premium when it comes to FHA, and something that you definitely need to educate your clients on, is the upfront premium. FHA loans have MPI, I believe it's called, mortgage protection. I forget what it's specifically called, but it's a 1.75% of the loan amount is due at closing when it comes to an FHA loan. So the buyer, again, similar to insurance, they can choose to pay that all up front at closing, but typically buyers, they'll wrap that into their loan to the back end half of their loan. So it's always really it's essential really to educate your client on this premium, especially if they're an FHA buyer, because when it comes to closing costs, they need to make sure that if they're not going to wrap it into their loan, that they're going to have that additional 1.75% on top of whatever they're going to be paying for a down payment. And then regardless, if you're an FHA loan, you're going to have another annual premium that's just put onto the loan for an additional interest of 0.45% to 1.05% on average for the balance of the loan for the entire year. And then lastly, credit score, of course, conventional, as I had said, you need the higher credit scores, usually around 680 and up. And then FHA, you can go almost as low as, I think, 500, it says on the website, with a 10% down payment, but typically around 580 credit score. And then VA, typically it's usually around 620, but actually VA does not have any minimum credit score. But again, it's up to the lender to take the risk on you to do the VA loan. So of course, they're going to look at your credit as well. Any questions here, or anyone want to correct my notes if they're wrong? Which I don't believe, but okay.
I have a quick question, Teray.
Yeah.
On the FHA, on the annual premium, so they tack on the upfront, that's just a one-time, and then the annual, that's every year for the duration of that 30-year loan, correct?
That's correct. And I believe that if you get above 20%, I have to double check, but I think you can get it decreased at least, possibly removed. I don't know. I'll have to double check on that. Again, I'm not a lender, but this will be good questions to specifically ask the lenders when they come on later. I'm just trying to give everybody a general overview for now.
Okay, cool. Thank you.
Yeah, no problem. All right, so now we're going to just talk about some of the major residential mortgage lenders you're probably going to see in the market today, and then some just general information about them. So the first type you're going to probably see is mortgage brokers. So what a mortgage broker is they're basically an independent firm who works with they have a menu full of lenders that they work with, and basically they shop you around to all of these different lenders. So when I talk about a profile and your risk, and basically you are a profile when you're looking at it, when a mortgage company is looking at you, this is what they're shopping around. They're shopping around Teray Jones and my credit score and my qualifications and my ability, their belief in my ability to pay the loan to multiple different lenders. When they're shopping this around to these lenders, what they're doing is they're looking for the best rate, and they're also looking for the best overall deal. So it depends on each bank, and each lender has different types of requirements and different types of programs that they have for buyers. So what the mortgage broker's job is to do is to find you the best deal amongst their network of lenders. So it's always really interesting to ask the mortgage brokers, who are they selling your loan to? Is there any way that they can, shop it around a little bit more? I always try to see if I'm the buyer myself, if I can really get more information into how they're getting these numbers, how they're getting my rate, who am I going to actually be with? So some of the other benefits about mortgage brokers, specifically the two that I have on the screen, the two mortgage brokers that we work with are Evolve Home Loans and DuPont Lending. Each of them will be coming on the call. I think Evolve is going to come on first. Paul from Evolve Home Loans. And what's really great about them is that they don't charge any lender fees. So they get paid by the lender. They don't get paid by the buyer. So that's an important point and a benefit to bring your buyers to these types of mortgage brokers, because specifically if they're tight for cash or they just barely are qualifying, and they may not have very much of a down payment, you can bring them to these types of lenders. That you can provide them with these lenders to choose from as an option to help them better increase their chances of purchasing a home. So are there any specific questions from anyone about mortgage brokers? Any corrections? All right, good. Next, you got mortgage bankers. So mortgage bankers are the most popular lenders. These are the people you're going to see: Rocket Mortgage, Quicken Loans, Wells Fargo, Chase, Bank of America. These are all just big institutions, banks, credit unions, mortgage lenders, online mortgage lenders. These are all just different companies who sell directly to, or they purchase loan, or they basically provide loans directly to the consumer. So they come in a bunch of different varieties. You got your online mortgage, your online mortgage bankers who compete on price. So they might try to just compete on the lowest interest rate, but then they don't have a lot of the other services that come with it. So something that happens with these types of banks, because they're the ones that are providing the loans, they can really mess with the interest rates in order to maybe help that more. If that's a buyer who might be more interested in the long-term benefits less than the short term, you might want to advise them, hey, maybe you want to go look at our partner Fairway Mortgage, who we work with out of the West Side. They might be able to compete on that interest rate a little bit better than a mortgage broker would, because they're the ones providing the loan. So this is what we're trying to kind of focus everybody on, is it's all dependent on when a buyer doesn't have a lender or someone, or they're not happy with their lender. It's important to kind of understand their situation and what might be the most value added to that client. So if they have a lot of the down payment's no problem, their conventional loan, they're even thinking about buying down their mortgage rate, which is something you can do. You can buy points and purchase points to buy your rate down. You might want to push them to Fairway Mortgage, because they might be able to get a better deal on that interest rate, rather than Evolve or one of these other companies who might not be able to help compete on that specific interest rate as well. So that's just something to kind of think about. But a lot of these companies, the reason why they do this is because immediately upon basically funding that loan, they're going to turn around and they're going to go and sell it on the secondary market. So they've got the numbers figured out. They have a set number of loans that they need to make for the year. So now they're really just shopping for the best candidate who's going to be able to help them do those loans, because they know they're going to turn around, they're going to sell it to Freddie Mae and Fannie Mac right after they purchase it. So this is something that happened to me. I mean, I think it was 2 weeks and my loan was already sold to somebody else. So it's just something to think about. Next, we got hard money lenders. So if you're working with investors, or you want to be an investor yourself, you probably want to get involved and get connected with a hard money lender. So what hard money lenders are is they're basically private money. They're private companies or individuals with large amounts of cash reserves. So if you have a bunch of cash, let's say you're working with someone who's willing to lend you $500,000 in cash. You're probably going to work with a hard money lender who is going to have a lot of different requirements compared to a mortgage broker or a mortgage banker. They typically have larger down payments, so and a much higher interest rates when it comes to their loans, because they're private money. They're more used for specific types of deals rather than like a buy and hold kind of property where you're going to purchase it and you're going to live in it, or you're going to turn it into a rental or something like that. A hard money lender probably isn't going to be the right type of lender for that type of situation, because often these types of lenders, they when they lend the money, the hard money, they typically need to tie that money to the property itself. So you're paying that high interest rate, but then also if you end up defaulting on your loan to them, then they can go ahead and take the house. So you really need to be strategic and smart when it comes to hard money lenders, and have a plan, and make sure that the investors that you're working with, that they at least have a plan for what they're going to do with the property, whether it be fix and flip, wholesale. There's a lot of other things you could probably do with this type of money, but it's always important to be cautious when it comes to these.
Sheree, I have a quick question on the hard money lenders.
Yes.
What would be an example of that? Is it like at the private company, is there one that is well known that people could go to, or how would somebody go about finding a hard money lender? Do you know? That?
Kenyatta might know more, but in my experience, it's kind of like a network thing.
Okay. Yeah.
Typically, it could be it could even be a family member.
Yes.
But as far as like a strict institution, I'm not really sure. I know that people create their own little independent funding firms, because then they can lend it out as a business, but I don't have any names right off the top of my head.
Sure.
And
Okay.
you also see that there's a lot of venture capitalists out. I have a list of different hard money people I worked with in the past,
Okay.
all over the country. It's just on whose rate is what, but venture capitalists also are another source.
Okay. Awesome.
Yep.
Thank
And then lastly, this really doesn't affect us as residential a buyer, but the second is the secondary market. The last thing type of lender is the secondary market. So these are typically Fannie Mae, Freddie Mac, Penny Mac loans. These are just different companies who are large firms, venture capitalist firms who basically they purchase properties from different mortgage lenders, and then they basically repackage those mortgages into mortgage-backed securities. So basically they convert it into these mortgage-backed securities, which then they can then go and sell to other investors. So typically a lot of investment firms, like you'll see that these are called REOs, or real estate enterprise owned, I believe that stands for. And these are just large like funds. You can go on the stock market today and go and look it up on your TD Ameritrade app or whatever app you use. And you can specifically look for these types of institutions who buy these secondary market lender loans, because they buy a bunch of mortgages as a package. And then that's just a way that they can provide different types of financial security and investment for other people. But this is just something to kind of be aware of, is that a lot of these properties are just then sold to these types of institutions, with Fannie Mae and Freddie Mac being the two that are backed by the US government. So they're usually the big purchasers. All right. So lastly, I'm just going to close with just one quick slide on just a financial analysis, kind of just the general talking points that I kind of want to cover with each buyer whenever I talk with them. This is just kind of a sign off, just to kind of understand their general situation. And if they don't have a lender, a lot of this information will help me try to offer them one of our partners who might be the best fit for them, or they might be able to get the best deal. So when it comes to a buyer analysis, you really want to kind of understand their individual situation. Every person's unique, and everyone's got a unique situation, and a lot of these situations can be complex. So it's really important to kind of understand first, what is their overall objective when it comes to wanting to purchase a home through some type of financing. So what is their short and long-term goals? So for example, if their short-term goal is to do a fix and flip, potentially I know that I'm not going to steer them towards an FHA loan, just because it has to be their primary residence. There's a lot of extra fees. You can't really move a lot with that. So I might try to steer them towards one of our hard money lenders, or see about if they have any family or friends in which they can borrow that money for, what's their specific type of property they're looking for. Something else is important is you want to know if they're a first-time home buyer. We can do another course on that in the coming weeks about the benefits of first-time home buyers, but there's a lot of really good benefits when it comes to them, because you can get a lower down payment, a lot of different things when it comes to your closing costs that can be covered depending on the institution. So it's important to understand if this is their first time purchasing a loan, or purchasing a home, or obtaining financing. Second thing I kind of want to understand is their monthly obligations. Of course, the lender themselves are going to ask all of these questions, but it's always good just to kind of get a general idea. Do you already have a mortgage? Are you renting? When does your lease expire? Do you have student loans? About how much student loans do you need? Because that's going to depend on what type of financing you're going to be able to qualify for, because a large amount of student loans, and depending on when you got it and what type of work you're doing, that's going to really decrease your debt to income ratio. If you're going to have this really high school payment. So there might be something I need to know there. And then also, what percentage of your income is spent on your monthly housing payment. This is in relation to the debt to income ratio. And something that we can really get into detail later on is a lot of the debt to income ratio is one of the major factors that lenders look at. So based on all the money that's coming in, how much of that money is going to living expenses? So your mortgage, your credit cards, your utilities, a lot of these different charges all factor into this number, so that they can kind of understand, okay, can you really afford to tack on this extra loan? So it's kind of good to understand that going into it. And then second to lastly is the financial health. So what's your general credit score? Because I might be able to save them some time and maybe help tamper their expectations when it comes to financing. Because a lot of times people really just, it really surprises me sometimes, like what they think that they can qualify for with their actual situation, you know. So someone might think that they could qualify for a $500,000 house when they might be working a $20 an hour job, part-time job or something like that, you know. So it's just those types of things where you kind of want to understand their overall financial health and credit score and such prior to going into this. And then lastly, I kind of talked about this a little bit before, is the cash to close. So really educating them on the 3 different types of closing costs: lender fees, third-party fees, and then the last one is title fees. Sorry. And those are the 3 different kinds, and just kind of understanding based on their financing type as well. So if you know that they have a lower credit score, so let's say you're working with someone who has a lot of cash, but their credit score is terrible. So they're not going to be able to finance, they're not going to be able to qualify for a conventional loan. Something that you'll want to let them know is about that 1.75% loan to loan interest rate that's going to be charged at closing, so that they can be aware of that when it comes to closing. So again, a great tool that we have for our team, let us know if you don't have this, is our TGRI buyer questionnaire. It's just a Google form that we have that you can go ahead and just send to your buyers prior to meeting with them, so that they can just provide some really quick, easy information. And this information is really good to have going into the conversation, so that you don't spend so much time learning about them. Instead, you can kind of get down to the situation and how you can help them move quickly in order to prepare to meet whatever goal that they want. So that's kind of just a general buyer analysis that you can do once you begin getting in contact with your buyers. So I think I've talked enough. I guess we're going to just open it up to any questions or answers, anything that stuck out that I was wrong. I like to hear that. So please, anyone got any questions or anything that we can open up to the group?
I have a question for Ray.
Yes.
So do you know anything about someone being able to buy more than one property where it's owner occupied, or once they have an owner occupied mortgage, they wouldn't be able to get a second? Do you know that?
So if they have like you mean a mortgage that would require them to live in that property?
Yeah.
Yes, then that would then they're probably just going to have to qualify for a financing type that does not require that if they want another property. So they would need to qualify for a conventional loan, most likely. So they wouldn't be able to qualify for an FHA. But something that I've been investigating personally myself is if they're in that situation and their credit and their situation has increased more since they've lived in the property, then they can reach out, especially in a time like this where mortgage rates are so low, they can reach out to their lender to see if they can refinance their property into a conventional loan, which would then free them up to do an FHA loan.
Yeah. Okay.
Yes. So if they refinance into a conventional, then technically, if they're in the right position financially and they can qualify for another FHA loan, then they could probably get that benefit for another primary residence. But that's just might be a strategy. You got anything for that, Kenyana?
Yeah, they can also, if it's within so many miles apart from each other, it can qualify as a second home and then get that other loan without it becoming an investment property. If that answers your question.
Yes, thank you, guys.
Yeah, that's why it's important to kind of partner up with lenders who can be a little bit more creative, who don't just think about the bare standard way to do things. There's a lot of ways that you can kind of use these types of financing types to your advantage. So like, for example, well, we don't have to get into that, but specifically, I would say in that situation, either they have to purchase, if they still want to live in that property that they're currently at, then the next property that they want to purchase has to be a conventional loan, unless they have hard money or something else that they could do. Anyone else? Let me see. I don't know what time it is. 6:49. Okay. If not, thank you everybody for joining the call tonight. Of course, I hope you got some benefit from it. If you had any questions that you didn't want to ask on the call tonight, no worries. Just please email us here at teamgoins@gmail.com or add us if you haven't already on social media. I will also come up and build a slide later on with some of our other team members' information. We're working on just centralizing, like I said, a lot of our tools and resources that we're trying to get ready for the team. They're kind of just in the last final loading phases. So we really just got to finish completing those before we make them available. But up until that time, we're going to be coming in every week, teaching different topics, different things that people are dealing with in the market today. We're just seeing a lot of these interest rates starting to decrease, which means a lot of more buyers are starting to become available again. And as more listings become available, buyers are going to be in a better position in order to get into houses. So it's just a good thing to always just have your knowledge when it comes to buying and financing, because that comes into handy on the listing side, because then if you know all the different types of financing, what are the benefits, the cons to these different things, then you can better educate your listing client when it comes to evaluating offers with buyers who have all of these different financing types. So that's just the last little piece to leave you with tonight. Kenyatta, did you have anything to close us out? Didn't hear you if you said something.
Ken, are you okay?
I said no. I'm fighting a cough.
Oh, okay. Caught you at a bad time. All right, no worries. Well, thank you everybody for tonight. We'll be back again next week. I believe we're going to have some folks from Evolve Home Loans. So if something sparked your curiosity or questions this week, just have them ready for them next week, and we can definitely ask them. And then some other classes we got coming up are solar. So we're gonna get another team member, Scott Hendary, on the call. He does a lot of solar stuff. So he's gonna help us educate us on the benefits of solar and how we can provide that benefits to our clients. So thank you all for your time tonight, and I really appreciate it. And thank you again. So have a great night, and talk to you next week.
Thank you, Teray.
Yeah, no problem.
Great job.
Thanks,
Great job.
everyone.
Good
I really
job.
appreciate the effort you put into everything, Teray.
Good job.
Oh yeah, thank you.
Good to see everybody.
Yeah, thank you, Wade.
Bye, Wade. Bye, everybody.
Bye, guys.
Bye.
Good night.
Bye, have a good night.
Love and blessings.
Bye, TC. Well, that concludes our show for today. We thank you for joining us. I'm Dr. Goins. I just want to say thank you for joining in, and we want you to come back next week for more and bring a friend. Tell somebody about what TGRI is doing and how we're trying to bring real estate professionals all together in one area. Don't forget to check out the description box below for a link to our weekly Zoom calls. We hope you join us then, and may God's best be yours. See you then. Have you been looking for a realtor and just don't know who to pick? Are you looking to sell your home or buy a new one? Or perhaps you're looking for an investment property? TGRI Realtors is the team for you. Give them a call. They'll take great care of you. The number is 650-427-0539. That's Team Goins, the Christian Realtors. Give them a call.